Dear friends, welcome to PMS Insights. While all of us, individuals and corporates, have been taking into account the damage caused by COVID-19, let us look at some of the positive outcomes of this unprecedented situation. One positive impact on corporates is the high focus on curtailing costs, some of which can revert to the original levels as recovery happens, but some can also be sustainable even in the post-COVID world. While the top and bottom lines were out of control for most corporates, the one thing which could be controlled were costs. Most of the companies have managed to maintain a stronghold on costs, which led to EBITDA margins being similar to normal levels, or in some cases even better, as the costs were lowered dramatically. The cut in costs has come in many forms, be it lowering of advertising or marketing spends, lower travel costs, negotiating lower rentals, increasing productivity, or even reducing salaries or headcounts in some extreme cases. Other potential benefits, apart from cost-saving measures, include a possible change in consumer behavior tilted towards online ordering as it becomes easier, reliable and convenient to shop. A look at the digital transactions, payments via UPI or IMPS, shows that they have not only recovered but are also above the FY20 averages. This proves the digitization efforts of banks, infrastructure and the government has begun to pay off and is a trend which may improve further in the future. Now let us look at the sectors which are likely to emerge stronger from the crisis. The IT sector is expected to benefit as work from home results in better margins due to lesser travel and likely lower employee benefits, and the need for digitization drives higher sales. Automobiles can benefit as marketing efforts are now focused on digital medium and need for personal travel goes up. Consumer goods, durables and other branded good companies can also benefit from industry consolidation and increased demand for personal hygiene and home automation products. Also, the pandemic has forced businesses to reevaluate supply chains, leading to India emerging as a preferred second source of exports alongside China. Lastly, pharmaceuticals, healthcare and diagnostic businesses continue to be resilient during these times of uncertainty. Amidst this, the recently concluded Q1 FY21 earnings managed to beat muted expectations, and most of the corporates are assuming full recovery only in FY21 second half. While the revenue and PAT dropped significantly as expected, tight leash on costs have helped maintain or even improve margins for most corporates. In top 200 core equity portfolio, around 78% of companies delivered results above or in line with estimates, and 22% companies delivered results below estimates. As seen in the table, 7 of the top 10 holdings of the portfolio have outperformed the benchmark over the last 1 year, and the earnings growth outlook for the top 10 holdings is improving going ahead. New additions to the portfolio in the last 6 months include companies from the COVID resilient sectors and also sectors which are likely to emerge stronger from the crisis. In the IT sector, we have added Wipro, which may benefit from the induction of new CEO and also improved cloud and digital adoption. In the healthcare space, we have added Dr. Reddy's, which is expected to benefit from the branded generics portfolio led by acquisition of Wockhardt in India, along with new approvals in the US markets. We have also added Power Grid, where the availability-based return model of operational assets affords a high degree of EBITDA and earnings resilience to the COVID-19 disruption. Our focus continues to be on companies which have good managements, strong balance sheets, and have long runway for growth. Thank you.